Hi, I'm Keith McCullough, and welcome back to Real Conversations, where I just had an excellent conversation with one of the world's best analysts on gold. He's incidentally also the founder of Goldmoney, one of the founders, that is. But he reminded me of why I am a long-term gold bull, while I might be bearish in the short term or bullish in the short term. Long-time gold bull. This is going to teach you a lot. Well, welcome, Josh. Thanks for coming to Hedgeye. We appreciate it.
Yeah, thanks, Keith.
I've been waiting for a long time to get you here. For those of you that don't know who Josh Crumb is, he's the founder of Goldmoney. I think not only are you the founder of a company, but you're probably the best gold analyst there is, because you do it your way. I wanted to give you a chance to just kind of give people the path. Like, how the heck did you get from Colorado to being, Goldman analyst, and now where you are now?
Yeah, no, I think, and that's probably the right way, because I've never considered myself a gold guy. You know, I like the math of gold. I never actually liked gold, you know, the way like Donald Trump likes gold. Right? Like I just like the math. And so for me, it took a long time. It was the most curious thing. And so maybe I'll kind of walk through, because it's always good to know my bias and my background before we discuss, views and everything else. But so for me, I started out as an engineer, background and then grad school mineral economics and political risk and all sorts of interesting things, because in resources you have to know all of this stuff.
Mm-hmm.
You have to know finance, you have to know geologic risk, you have to know political risk. So for me, I kind of wanted to. I'm a systems guy, so I kind of wanted to know how it all worked. But the way I actually came to gold, even as a Colorado School of Mines engineer, economics department, geology department, they teach you that gold is worthless. Gold is this, focus on something useful for society, zinc or copper or coal or something, right? So even there, they don't understand gold.
So
which,
Colorado,
maybe now, but certainly when I was in school in the late 90s, early 2000s, and this is when all commodities were like in their nuclear winter, right?
But this is, the Colorado School of Mines is a very reputable place, if not one of the most reputable places. But that was their ideological view.
Yeah, well, I think it was, and this is more the economics department. You got it from some of the engineers as well.
Right.
And obviously there's a whole spectrum, right? But at least my takeaway was I didn't understand gold leaving university. I understood oil, I understood copper, I understood water. I understood a lot of resources, but I didn't have an understanding of gold. And then I, working in corporate development and building mines, buying assets, things I did on the corporate side in the Canadian resource sector. I hated gold multiple. I hated gold companies that never actually produced cash flow, right? So I actually came into this not liking.
Are there gold miners that actually lie to people? Gold mining company executives? I haven't heard of that in Canada.
Yeah.
In Vancouver, weren't you in Vancouver?
Yeah.
Isn't that where everybody tells the truth?
I know exactly. Well, I like to say that the old Mark Twain adage, a gold miner is a liar standing next to a hole in the ground. Well, with today's technology, they don't even need a hole; they just need a PowerPoint. so it's.
That's great.
But yeah, so I came up sort of hating gold. But where I started to figure it out was actually more and more understanding systems of energy in the economy. So let me give you an example. When I would do an M&A model, comparing an asset in Zambia to an asset in Chile, and doing an MPV swap, merger, whatever. You could go line over line by first principles. What's the risk in the geology? What's the energy it costs to put into the ore, to mine the rock? Then you can make an oil price assumption. Mm-hmm. All of these first principles got you to a cash flow level, but there was one thing that was the most uncertain part of the entire model. What's the value of a Zambian kwacha? What's your labor cost? Same thing with Chile or anywhere else. Mm-hmm. Same thing with Canadian dollar, modeling the oil sands. So the most uncertain and most, the one thing in those resource models that you couldn't value on objective metrics is what is the currency going to be worth in 3 years. And so for me, I felt, I actually developed this system of, I'm going to throw out the currency. I'm going to think about it in energy terms. I'm going to think about, what is the cost of energy and labor? What is the inflation of their cost of living and energy? Because grains, food, bulks, water, all of this is very energy based. Mm-hmm. And so I kind of started developing a model of the economy that was just based on energy. And it really took me another 5 years of doing that, trying to like convert things to BTU and all of that. At some point I realized that gold is nothing but a measurement of energy. And at that point it all sort of started clicking for me.
Were you at Goldman at this point or not?
Yeah, it was as I was leaving Goldman. So my first part of being a metal analyst there, I was focused on copper and zinc and other things. We ran the gold model on real interest rates like everybody else, but I didn't sort of have the full picture until after. And it was really after meeting my co-founder and CEO Roy Sabag, who really brought the rest of the puzzle. He was a finance value investor guy that found gold as a value investor currency.
Oh, really?
And so his understanding of gold as a currency kind of combined with my understanding of natural systems and energy, and we kind of put together this framework.
So Roy was actually the buy-sider, right, in this situation. Buy-sider being an investor who was investing in either gold or gold-related assets.
Exactly.
Okay.
Exactly.
And mines too.
He owns I think 4 resource deposits personally, and
really?
he bought and sold mines.
But his basic, and this is kind of an interesting, when we were at Macrocosm, which you did a great job presenting at that, you had a ton of feedback, because people are like, who's this guy? Where did you find this guy, Josh Crumb? And I'm like, well, he kind of sounds Canadian, but he's not Canadian. He's from Colorado and he likes hockey. But you're perfect there. And one major value investor, David Einhorn, said the same thing. He believes that gold is a currency or a store of value and or both. I mean, can you once you got to that point, which I believe a lot of people, and correct me if I'm wrong, but I don't believe a lot of people believe that it's a currency or B, a store of value.
Right.
At what point was that in your life?
Yeah, so I think it was really, actually the actual point that I really figured out the store of value function.
The energy function.
The energy function is you go, so what's the fundamental of commodity volatility? The fundamental of commodity volatility is storage. So what's the most volatile commodity? Electricity. What's the least volatile commodity? Gold. And if so putting aside any views of money or theories or all of this, let's just look at the objective math looking backwards. Gold has currency-like volatility. It doesn't have copper volatility. It doesn't have equity volatility. It does in its tails, and we're going to put out a whole report on that. But for the most part, it's every day that it's moving just like the euro is moving, or it's moving with currency-like volatility on interday. But back to that spectrum of commodities. So you have flow or OPEX commodities like electricity, and then you've got natural gas, you got oil, and then you start getting into the more, and then you have something like coal. And then you have the more CapEx commodities, things that last longer and easier to store. You get into aluminum and copper, and then eventually you get to gold. And so what the fundamental, and grains is a flow commodity as well, because the cost of storage and decay. So this is all fundamental stuff. This has nothing to do with economics. This is physics. This is, there's a cost of production, and there's a cost of carry that's quite volatile because it's expensive. It's expensive to store electricity. It's expensive to store bulky, low-value grains because they rot. So I kind of boil everything in the economy down to two or three things. One is the energy cost of production and the energy cost of storage, which is your carry or your decay. And so gold became natural money because it lasts forever. It has a very high, relative to everything else, because it's scarce, it's got the highest energy cost of all of these different things to produce. So its replacement cost or its value basis is an energy, about 70% energy, pure energy flow to create gold. So I brought some gold with you. So hold it in your hand here. So each one of these is 10 grams.
Each one of these this is 10 grams of gold.
Yeah, and even a high grade, 1 gram per ton deposit, that's 10 tons of rocks moving. So it's
just
for this one. And so what that means is that's extremely energy intensive. But once you mine it, it lasts forever. You can use it with almost no cost of energy. You're not maintaining it, you're not cooling it to ship it around, it's not bulky in cost. So the carry of gold, it's this very scalable technology where once you produce it, you can use it forever. It's like producing a CD, and once you have it digitally, you can distribute it everywhere, or a Microsoft operating system. So it's an extremely scalable technology. But what is it? Sorry.
No, that's an interesting thing, because very few people will say that gold is a technology. But as an element, these are not rocks.
Right.
This is an element.
It's an element. Exactly.
And we will hear constantly from mainstream media or fake news, whatever you want to call it at this point, that these are rocks. Right. These are not rocks, Josh. No. this that's in my hand, I don't know if you guys can see how much I have in my hand here, but this is heavy. Relatively heavy. How much?
Exactly.
How much money do I have worth of gold here?
About $5,000.
Yeah, $5,000. There's no. You can't. I don't. Maybe. If I had that many diamonds, how much would I have in my hand?
Yeah, it depends on the quality. It's very subjective.
But
it's carbon. It's condensed carbon. It's not. It doesn't have the same scarcity.
How about yellow snow? If I had that. The reality is that there's a lot of storytelling about
exactly.
this.
Yeah.
And that's another key. Part of the pun, but key element of your view is that it's an actual element.
Yeah, exactly. And
technology.
Yeah, and I think so if you think about that carry function and why that makes it good money, is because the marginal transaction cost to use it as money, to swap it. So people always use they use that analogy or that story. Gold is worthless because if I'm locked in a room, if we were locked in this room right now, we have water, we have some food. This gold is the most worthless thing in here because we can't do anything with it, right? We don't burn it, we don't eat it. When was the last time you ate a $100 bill? What time? When? Maybe you can burn it for fire, so it has some utility there. But money is not supposed to have consumption utility. It's supposed to have lasting utility. That's all. That's its one function. Is it's supposed to last.
Well, when you talk in your terms, which I think is the most important thing for certainly our viewership or audience, or a broader one, people are actually trying to learn, is store of value has to have certain attributes.
Yep.
Store of value. You have to start with that. If something's a store of value, no, you don't have to eat it.
Yeah, exactly.
Okay, so store of value, go on from there. How do you build the case now into Goldmoney? And I don't think everyone knows functionally what. For those of you who don't know what Goldmoney is, they have actual Goldmoney cards. So maybe, I don't know if that's a good spot to start. Sure. But how you'd explain.
Yeah, maybe I'll finish. Sorry, I won't talk about the company yet. I'll finish the gold story here for a second.
No, that's perfect. Fine.
But because realistically, that's the most important thing. We built a business because we really believe in the philosophy and the knowledge that we have about gold being a very useful currency. And so we built a business to do that. But I maybe just finished on the importance of understanding it as a money stock rather than a commodity flow. So all commodities, it doesn't matter, again, electricity to oil to grains, they all are anchored in their cost function, right? Their marginal cost. But that's not their volatility. Their other than the currency component, which is moving wildly, again, the energy to put into the earth, that's not changing that much. No. That geology is not changing at all, at least on any meaningful time scale.
We can measure and map it too.
Yeah, so this is all very objective math. That's what, getting back to, I like the math of gold. It's actually pretty simple. It's got this sort of deep simplicity in that, the cost function is very energy based and it doesn't change. Where the volatility comes from is the cycle. It's the demand for it. It's the inventories, the capacity, and of course, when you get lower inventories and lower capacity, things get more volatile, right? You go into backwardation. You have you get scarcity. You have people bidding for copper, and bid up the price. But every commodity function has this discount of storage and decay. How much it costs to store and how much the grain rots or the electricity can't be stored, all of that. So that's the downside to your marginal cost. The upside is when it's scarce and people are bidding a premium. So that whole volatility has nothing to do with the cost where it's anchored. It's the demand and the cycle. Now, gold is completely different because gold is a money stock that just keeps accumulating and accumulating. So there's now $7 trillion, roughly, worth of gold money stock and inventory. So the latest flow numbers from India or China, or the latest flow numbers of the ETF, are actually fairly irrelevant, but that's all we're reported on. We're told that people want to bean count gold like it's oil or copper.
Because they want to adhere to the old linear supply and demand model of a commodity.
Exactly, you're not just, the availability isn't just this year's production. It's the last 5,000 years production. so the actual inventory volatility is extremely low.
So that's the 7 trillion that you're talking about.
Exactly.
How do you get to that 7 trillion?
So that was a study, the original Goldmoney, so the company that Roy and I founded was called BitGold, and we acquired James Turk's Goldmoney. But James Turk did a study, I think, I want to say about 10 years ago on what the money stock is, which is typically referenced in a lot of the academic studies,
yep.
And it's roughly around $7 trillion.
So gold mined, gold in circulation, the total nut is 7 trillion.
Yeah, and so you're adding maybe 2% a year, something like that. So it's
That's
not
one way to think about it.
Yeah,
okay.
Exactly. Which is, coincidentally, is also a population growth number. It's an inflation target number. There's a lot of reasons for this that are based in the natural world.
Well, if you extend that to fractal math, you call these similar sets. So there's similar sets. If you believe that it's part of the natural world, then there's a lot of similar sets or different things that are repeating, including population growth, that end up not dissimilar in the end.
Exactly.
It's kind of an interesting, that's very interesting, 2% population growth and 2%
it was a little more volatile the last few years because our currencies have been so volatile, and then you had all this new mine supply, and there's volatility in that, but I'm talking about a very long-term
Well, what
trend.
You're saying is that actually there's the cost and then there's the volatility, so you're separating them anyway. You want to establish the baseline.
The anchor, the value, the theory of value.
And then the volatility component, so talk about that.
Yeah, so the volatility component is essentially a currency volatility component.
Yes.
And so, but it's not quite so simple that gold is absolutely constant, because there's an energy component. Again, the value replacement is an energy basis. So if we have a fundamental shift, a sort of a phase shift or a supply shift in energy, like we did in shale, that will actually change the energy component of gold. Mm-hmm. But then the volatility is the currency component, which is how much am I getting paid to use currency versus no yield but constant in gold.
Yep.
And so a lot of people say currency has value because of government decree, because you pay your taxes, because the military. That's not right. That's not what the math says.
The government told you so, damn it.
No, that's people use currency when they're paid to use it. When there's a real interest rate, when they're paid to actually hold currency because there's growth in the economy.
If you think of currency as a store of value, if you put an interest rate on it, then I get paid to hold it. That's it.
Exactly. That's why it generally worked in the 80s and 90s. It hasn't worked for much the last decade and a half. Because you're not essentially paid to use it in any real interest rate.
But that's why real interest rates matter.
Yeah, exactly.
And when they go to zero, that really matters.
Exactly. And so the volatility is coming from the currency. But the other really important thing to understand is we get so caught up that we're the masters of the universe, centers of the universe, that the CFTC reports and the ETFs drive all of the price volatility, and you hear the old adage that it's a big door in and a little door out. Once people want to leave gold, all the ETFs are going to flood the market because they're thinking of oil or copper, or some sort of commodity. But that's actually not true. So there's about 1 ton of gold a year is consumed in bars and coins, and the ETF fluctuates not that big compared to that, but jewelry is 2.5 times the bars and coins, and so people are like, oh well, that's decorative. No, it's not. Because 80% of that jewelry is India and China, and that might as well be a bar or coin. They're buying physical 24-karat gold bullion shaped as jewelry instead of a maple leaf or an eagle, but they're buying bullion. They're holding money. That's their banking system, and so that's all a huge money stock flow that needs to be factored into what's happening to the renminbi and.
Do you know what percentage of the 7 trillion in stock is in China and or India combined? Is
You
there any
know,
way to get that number?
there is, and these are some of the numbers I probably should have off the top of my head.
But there'd have to be self-reporting, wouldn't there?
It is and it isn't, because there's all that historical accumulation and turnover.
Okay.
I mean, again, this is 5,000 years of turnover. You go to even the slums of India, they have net worth in gold. Maybe it's $20 worth, but they don't have a net liability sitting over them $150,000 per citizen or anything either, right? So they have a net worth. They're all accumulating this gold, and that's actually been an extremely. We make the joke that the best carry trader on earth is the Indian farmer's housewife, and she is she's. Every day she's measuring and weighing, and she's borrowing against that gold, and then she's taking it back. She's always long and shorting her currency versus her gold. It's not like you just sit there and accumulate it for dowry. It's circulating. It's money. It's a deposit. And so that's where actually most of the world's gold still is. On a population basis, on a stock basis, and of course the central banks have a good chunk of it. But the gold ETF is not what's driving the price.
Mm-hmm. Well, to me, when you say that, that Indian housewife isn't dissimilar to me in terms of how I think about gold. Yeah. I have a store value gold. I've had gold since 2003, but the way that I trade it is in the currency. Right,
exactly.
So if I'm looking at, and tell me if this is actually making any sense in terms of, it's always interesting when I do something every day believing one thing. And you might be sitting there the other day saying, I can't believe that guy's believing that one thing. But that's exactly how I think about it. I mean, I really don't have a view on the daily trading of gold unless I have a daily view on the US dollar. If I had to pick one, it'd be the dollar. If I had to pick both, which I'm allowed to do, I pick rates and the dollar.
Right.
So is that dissimilar than the Indian housewife?
No, not at all. Not at all. Because again, she's going to have a cost of borrowing the renminbi to short it. Right? Yep. It's the same thing. It really is.
It's primitive. Maybe that's why I do it better than bad. I mean, you really boil it down, though. Yeah. I mean, that's kind of where do you see the pitfalls? What are the most obvious pitfalls that you still think are kind of ways people think? Why? Prevailing perceived wisdoms, fake news on gold.
No, exactly. That is the biggest problem. This is actually why I think particularly now people have to be long gold in an accumulation fashion.
You accumulate when it comes down.
Yeah. You should just always, just like we've been trained to buy the dip for the last 5 years on anything. It didn't matter what.
But not
the
gold.
Dips buy it.
Not gold.
Yeah, exactly. Not gold. But gold, you're in that accumulation. We had such an extraordinary year in central banking last year. I think people don't recognize with the Trump election and everything else. I'd put it above things that happened in 10-11 with QE and all of that. NERP, banning cash in India, and now fixing the yield curve. You can't predict the weather 24 hours from now, but we're going to tell you what interest rates are going to be 30 years from now. I mean, we have extraordinary things happening.
Oh, I'm a big buyer of that, though. Yeah. I believe these Federal Reserve guys can completely measure and map the heavens. I mean, that's where we're going to have a big argument here, buddy. I mean, these guys are so smart.
Their models work so well.
But negative interest rates, isn't it surprising actually that with all that happened, because I agree with you 100%. Gold goes to $1,900 in 2011, 2012 when Bernanke took the dollar to a 40-year low. That makes sense if you're following the currency. Dollar's at its all-time low, gold's at its all-time high in dollars. But last year you got everything on the rate side. And if it's a competing store of value and the rates are negative.
Yeah. So this is the energy.
Why didn't it go to 19?
Exactly. This is the energy component. This is the most important thing.
I got it. Oil fell.
Exactly. And if you map the price of gold peaking and falling, has to do with, and not the spot price. The spot price of oil is determined by inventories and supply and demand. The curve. So when did the oil curve peak and start falling? 2012. When did gold start falling? 2012.
That's good.
So that your anchor was changing, not your cyclical. Yeah. And the other way I would compare 2011, 12 to now. So the anchor has come lower because we had an energy supply shift.
And the anchor, by the way, has got a huge correlation to the dollar.
Yeah.
The R squared on a 10-year basis between the dollar and WTI is 0.85.
Yeah, exactly. So currencies are a flow commodity.
Bingo.
So this is a stock currency. This is stock money. Currency is a flow commodity because currency is constantly being manipulated and changed and chased by central bankers. Just like oil traders are chasing the latest inventory numbers.
Right.
Central bankers are chasing the latest numbers, whether it's terms of trade and what is it? 60% of that trade is bulk commodities, which is energy. So it's all very related here. But currency is more flow commodity than gold. Gold is a stock.
So I think people are really starting to learn here. Once you go back to this energy component.
Right.
So you get the nirvana in NERP, but you have a lower cost of energy. Your cost component comes down.
Yep.
Is it possible that gold goes above and beyond their prior highs, 1900, unless oil reappreciates or reflates?
Yeah. So it's the feedback loops that are important, right? So you had lower oil price, which means stronger dollar, better terms of trade. It also means better consumer spending, so it's a higher real interest rate, and more money in people's pocket, more growth. So these are all positive feedback loops.
Yeah, that's when gold got taken down by $200.
Exactly.
Because you basically had U.S. growth accelerated on a real basis, dollar up, rates up, gold down. But we're talking very short.
And the central bankers took credit for that. But map your labor numbers with numbers in the oil patch. They're completely inversely correlated. The labor growth we saw for the last 2 years was lower energy. That was the real economy growth because there was real energy prosperity on a rate of change basis. So that's where so they all want to run around patting themselves on the back. We printed this balance sheet, and so now we created growth. No, the shale oil, which by the way most of those people had their way, shale oil wouldn't be allowed. So they were not the reason for this growth. It was financial easing through the form of oil. And so that's where that was a lot of the growth came from, and that's why gold was selling off. But now these compound the other way. So now we've got back to our basis. We actually are on a down cycle of energy. Wait till we wear off this capacity, then it's going to be compounded at an even higher rate. So this is where gold really starts gapping up again. So this is the 2003 to 2007 phase.
Because your cost basis is effectively crashed.
Yes.
At 30, call oil, it's crashed whatever level, 30. Now we're back 50 and change. So we're finding that rate of change bottoming process in your cost basis.
Right.
Okay.
But it's a floor. It's not this. We've now set a manufacturing
because you're
floor.
using the long-term. We're not like. And for those of you who don't know, I'll just tell you right now. I mean, if I'm trying to give you a gold signal that's literally $100 range in dollars on the gold price, that's so immediate term relative to what he's talking about. What you're talking about is a 5,000-year time series.
Yeah, exactly.
No,
for sure.
So if you go back to when people look back at the 80s and the 90s, the average price of WTI was sub 20.
Yeah.
So back then you shouldn't have had an unbelievably high gold price.
Right. But measured in gold, it was very consistent.
Exactly.
So it doesn't. So that's where people say money is so subjective. It's a construct of our mind. Oh, it's not. It's objective.
The math I look at is of whose mind?
You just this whole money's this religion that you have to believe it has value and that someone else is going to buy it. No. So and I had this debate with central bankers on a panel
big ones
a few weeks ago.
Big fight.
Yeah, and it was amazing because they all have this subjective theory of money. Just because their models are more and more wrong doesn't make the economy more and more subjective.
Or gold subjective.
Yeah, exactly. I look at objective reality. I'm an engineer. I look at math, and I look at the objective function in markets, not the subjective and the manipulative function. And so, because over time those reconcile. And so what I was saying to them is, the best proof of gold ever is the fact that it has been demonetized for the last 40 years, and it still works. So it wasn't their decree. It wasn't the gold standard. It wasn't the Bank of England. It wasn't. None of them actually made gold work. Gold worked with or without them. That's the most important fact we've had. Because if you so we did a report for Back to the Future for Marty McFly, where we said, what are the price differences between 1985 and 30 years later in 2015 when he landed? And we started with the Big Mac index, and gram for gram, a Big Mac cost exactly the same as it did in 1985. We looked at housing, we looked at education, we looked at his truck, his really cool black Toyota truck. We looked at all of these things, a movie ticket, pure service economy. all of them, gram for gram, gold held its value. Now within a cycle, that's not true because of energy, because of flow of commodity, of currency. So within a cycle, we don't know. But through cycles, gold holds its value, which is the most important point.
People in the U.S. in particular, just if only because it's been beaten into them to the point that they almost have to believe it.
Yep.
But they'll believe that for stocks.
Right.
Jeremy Siegel blasts that into their head, but stocks, for the long run, long run. It's like you can yell it, you can scream it, and people only believe it once after stocks have gone up. But why don't they believe that in gold when the numbers are much more obvious?
No, exactly. Again, there's this deep simplicity to it. This isn't rocket science, right? Like this is,
But why? How can we,
element.
as a population, or certainly as a profession, forget the population. I mean, we don't want to go and say that every human being should understand this implicitly.
Right.
But why do you think we, as a profession, are so bad at understanding the objective fact here?
So because it benefits us. Us being 1% finance
Wall
guys,
Street.
This is sucking money up to us, this system. So this is actually not good for us. And so this is where if a portfolio manager, sort of middle America portfolio manager, recommends gold, that's scaring somebody. That means they won't buy an equity at its 99th percentile valuation. So that is bad. They then don't get the commission. They don't get the ticket. The incentive of the financial system is to get paid, and you don't get paid with gold. You just stay even, and your clients won't be paying a premium to you in the short run for something that's worth less in the long run. So for us, there is an incentive to not like gold. So what I always say is when I'm pitching my business or talking to people, the CEO gets it, the taxi driver gets it. All the guys in the middle don't get it, of a financial institution.
No way.
Right?
I mean, and you worked at Goldman Sachs.
Yeah.
I mean, did people understand that then?
A little bit. I mean, some people for sure.
Yeah, now a lot of you have led the
Blankfein
charge.
was a gold trader. Cohen was an aluminum trader. There's a lot of commodities within Goldman.
Do you think Cohen? I mean, Cohen's a practical guy. I mean, he's not a Rhodes Scholar, but he's a practical guy.
Yeah.
He understands a lot more than I think people give him credit for.
Yeah.
Do you think that he could infuse in his new role, a pro-gold, a progressive gold?
I think with the right information, yes. I don't think they have it to this level. I think I think he's someone, and a lot of Trump's administration, by the way, generally understands gold like an Austrian economist would. That it works. They understand the math backward looking. It's not just some barbaric relic or some like.
Well, it's a big shift.
Fetish,
I mean, when you
right?
look at the regime of Larry Summers, Ben Bernanke, all their outcroppings. I mean, the reality is that they don't get it.
No. Well, they don't get oil curves, and they don't understand anything the physical economy. They think it's barbaric. They think consumer inflation and consumer products and services drive the economy.
Yeah, I met with a major. I mean, I can't say his name obviously, but you'd have to, like Trump would say, believe me.
Yeah.
I was in New York, major CIO. He said that he had to explain to Ben Bernanke what implied volatility premiums versus discounts were.
Yeah. No, it's well.
This
again,
is the guy
we
who
won't
wrote,
name names, but remember the person we were with, former Treasury Secretary.
Yeah.
and talking about oil didn't get it at all.
But
right?
it's no wonder then, if you have the Josh Crumb model, which is cost and volatility,
right.
that they don't get it because they don't get volatility.
Right.
And they look at cost, or they look at the perception of cost on a supply-demand basis.
Yeah.
So,
No, they think volatility is animal spirits. They don't think
course.
it's actually that we don't know what the weather is tomorrow. That's volatility.
This is coming from a guy, not to rip on him, but I will for a second. Ben Bernanke wrote the new normal for volatility.
Right.
At 10 VIX.
Right.
Which you've never sustained a closing low on front month VIX of 10 over any economic cycle, and
Right.
obviously people know this, but if you don't understand volatility, how the hell are you going to understand gold?
Yeah, and that's after they removed duration and volatility from the market by being the buyer of first resort.
Yeah.
If they were the buyer of last resort function, which was already bad enough in moral hazard, they've now shifted the buyer of first resort function where they're actually trying to set the price.
Yeah.
I mean, of course it looks nominally that there's no volatility.
No, exactly.
The real volatility can never be removed because we don't know the weather tomorrow. That's uncertainty is uncertainty, and you should wake up every morning saying I have no idea what's going on and try to figure it out.
I love that.
Not the other way around.
I mean, it's the core of complexity theory. It's nonlinearity rules the day. Embrace uncertainty.
Exactly.
So enough about them. Well, let's end with us because that's what really matters. When it comes to guys like us, you and I are, and for those of you who don't follow Josh on Twitter, you have to absolutely follow him. How do we get people used to the short term? Like I think it's pretty well known. We have real-time alerts trade gold, on a signaling basis, very short term, versus the store of value view that you have. Like, what would your advice be to people that follow me that are now following you?
Yeah, I think it's always a function of duration and capital, right? Yep. So people that are managing other people's money that have a quarterly or daily performance, what you're really doing is trading currency. You're not trading gold. You're trading currency, and your quad one, that works, and you've been right. Well, not the last week or two, but you know what I mean. Yep. When we from your macro conference, if people listen to me to be just long and you short, they would have worked with you.
And in the last 2 weeks from the low, if you listen to you long, I mean, the different durations is few.
Yeah,
and by the way, it's important for people to know. I mean, my Goldmoney card, which again, you can get these. You store value here.
Right.
You can aggregate gold there. I mean, that's what.
Exactly.
Isn't that? That's your company is kind of the answer. I'm not.
Exactly.
We're not trying to market your company, but it actually is.
No, and again, I think. If you have a sound basis and philosophy and all of that, the company will kind of take care of itself. So I'm always just trying to make sure that these views of gold are right. And what we try to do is we try to make gold work as practical money. So we know the store of value function, but why can't it be a medium of exchange? Why can't it be, particularly now that you have to, pay to use bank accounts in a lot of places in the world, with a negative interest rate, or effectively a negative interest rate, because their fees and overdrafts and everything cost more money.
Go to Europe, man. You're going to pay for it.
Yeah, but not. I mean, not even just the indirect, but even the direct. So anyways, what we said is what Bitcoin taught us is people are open to using other monies, and that's no surprise that Bitcoin rose the same time real interest rates were falling, just like gold. So it becomes an alternative money system that's better than paying to use currency. And so what we saw was all of the things Bitcoin was trying to do was just trying to mimic the properties of gold, where it has a high cost of production through cryptography, but then it lasts forever and can be used forever. So that was, it really has the same economic foundations as gold. But we thought, okay, well, that's really interesting, and there's a lot of cool things, but why don't we just use gold? Well,
gold's a two-way market. Gold's a transparent market. Gold, there's a lot of things.
It's a $7 trillion stock versus a highly volatile. What's the market cap of Bitcoin now? Like 10 billion or something, right? So it's just a much larger scale. And I actually like Bitcoin for a lot of reasons, but it's always going to be volatile because it's service economy based. It's not.
Well, we're still going to have a hard enough time convincing people that these aren't rocks. And Bitcoin can have its day, but the reality is that this is But
again, a lot of the world will understand this on a population basis. And if I'm looking at the next wave of wealth and clients I want, it's the millennials in Indonesia, right? And so we're catering to a population base, as any internet business should, not just the high net worth segment. So what we did is basically built a business that so it's free to open account, free storage up to 1 kilogram. So we take away the carry basis of gold's got to be stored and insured, and so we make it very easy, very cheap. Our spreads are 0.5% over spot price. So it's the cheapest way to own gold, cheapest way to store gold, and you can transact with it. You can get a free MasterCard, so you can actually spend. I can take my Canadian credit card down here and spend it at Starbucks, and no one cares that it's Canadian dollars, right? So now we have a card where no one cares that it's gold, but you can use gold as your savings account. But this gets back to
that's what this is, by the way. This is a MasterCard.
Yeah.
It's heavy, by the way, but it's a MasterCard. And you're accumulating gold.
Exactly. So we built this system that made it very efficient. So all of the gold is physical, all of it's numbered bars, it's in Brinks. And what we looked at is we looked at a technology business like Uber, Airbnb, just name drop or whatever, where the capacity already exists. There's already Brinks, there's already miners delivering bars, there's already all of that chain of integrity of where the gold comes from. how do you digitize all that capacity and make it very cheap and easy for the retail guy to access? So that's what we built, is really a software layer on all of that infrastructure that already exists. So when you buy gold from us, we may have bought it seconds before from a gold dealer with a numbered bar in Brinks.
Yep.
So we're just providing all that infrastructure, so you have physical gold underlying your entire account. And so that then now allows gold to function like a liquid currency, just like the Canadian dollar. So it's just a gold currency account, but it's fully insured, fully reserved, and there's no leverage in the system.
I mean, it really eliminates all the middlemen too. I mean, including my wife. I mean, so if I wanted to, the way I think about the trading side of the gold, let's say that gold goes down to by $150, hits my oversold signal. First thing I'll do is call my wife and say, hey, go buy this many gold coins. Or now I can when I covered the short side of gold, I put physical gold on the card. And that's a one way that I've thought about doing it, because my wife gets annoyed when I call her in the middle of the day telling her to go buy gold coins. I mean, it's not like...
You're going to like our next product.
Because you want to get or go online now, which is much more efficient, admittedly. But once you get into a routine, you do, and you see that price, physical price that you want to accumulate gold, it is a pain in the ass to go get it.
Right.
And somebody's going to rip you off with a brokerage fee.
Exactly.
And
that's why Roy and I started this business, actually, is for all, even if you do understand gold, it's not that easy, like you said. So in 2006, 2007, I own a water business in Colorado. The first time I ever made money, I bought water, not gold. That's how you think in Colorado. But my one risk was political risk, and what I thought was going to be a major financial crisis coming. I sold all my working capital, my water, and I bought gold. But even in Colorado, if there's one place on earth that should be really easy to buy gold, it's Colorado. It wasn't easy. It's not easy. Unless you're in a financial center, it's not easy to access gold. And so we just wanted to make it very easy. So you can, again, you can be a millennial in the Philippines and be buying $1 a day and just accumulating it in our system. And that's the way and that's actually my favorite use case. I don't think people should time gold because we don't know the uncertainty. If you understand it as a money stock, you should just be accumulating it with income. And
it's fractional. I mean, this could be all that other stuff you have solved. But just the idea that I could buy $10 a month worth of gold.
Yeah, and then spend it if you need to, like instantly.
It's awesome. I think it's so cool, man.
So that's all we did. Roy and I just, we said, why isn't anyone doing this? Like, how do you do it? And we took a couple of years, learned a lot from the technology industry and cryptography, and learned a lot from Bitcoin, and so we did a lot of things to make this whole software system work. Now it's there. So,
and not just the software system, but the back-end reconciliation of the trades, Brinks, people moving gold shelf to shelf. That's really what's happening, isn't it?
So they become both our custodian and our clearing agent. So they're both like DTCC and also Bank of America or BY Mellon or whatever, right?
Yep.
So they both are the custodian, but they're also the one that confirms. So when you buy gold from us, we have to know that it's physically there. And so Brinks then pings us in our server and tells us, this bar is now tied to the account, so we can say settled. And so all of this is obviously trying to happen as fast as possible, but it gives you the assurance, the way we built the architecture, the third party's clearing it. And again, that's the kind of things that Bitcoin taught us, is this whole decentralization where people may not trust us. We need these systems to make sure there's third parties reconciling everything.
And these systems, only a thank God you went to Goldman, the fully loaded, we're doing God's work thing. I don't think that you signed off on that, but thank God you went there because you thought of how to do this. If you were at Goldman right now and you pitched them your business, this idea, they couldn't get enough of it. Yeah. So at some point that's going to become reality. It's one thing for the banks not to buy off on an illiquid, opaque. I'm not the biggest fan of Bitcoin. I'd much prefer gold. Yeah. It's nothing against Bitcoin people, by the way. It's just what it is. I like one more than the other. Yeah. But there's a pretty good chance that there's one day that your old friends at Goldman and your new friends at Citigroup and everywhere else, they're going to need it.
Yeah, it's just a very logical banking system, it's another rail. And the other thing that we can do, we have a client in Singapore whose son goes to school in Canada. and he buys his morning Singapore, he buys gold, he sends the value of his gold to his son redeems it to his RBC bank account, same day. You can't do that in the banking system because gold is the bridge.
And he has a card.
It's this magic teleporter between two countries, which is what gold has always been. It's the cross-sovereign money because it's a bearer instrument, whereas currency is a debt instrument and is a contract that's based within a sovereign. So the correspondent banking system is extremely inefficient because you have to have a bank that actually has regulated entities on both sides, and some are deeper liquidity than others. And like people think that currency works like the stock market. It doesn't. It's this massive mess of all these different clearing central banks, correspondent banks. But with gold, because you own the asset, there's no liability. Once you own it, you can send the title anywhere in the world and then sell it and redeem it anywhere in the world because it's liquid in every country in the world. And Bitcoin promises all of that, but gold has already done it for 5,000 years. So we just wanted to make the system to do that. So yeah, there's a lot of pieces that are still in the works. Like round one, we really wanted to get it to the little guy. Like we really wanted to democratize access to gold, just like the internet business sort of ethos. So that was round one. Round two and round three, our Project X, we've got some really big things. Again, the correspondent banking system, how we use this for cross-border trade. I mean, our clients already do it. So, that retail client already has a better cross-border clearing system than, the central banks.
Yeah, exactly.
Which
is great.
Yeah.
That's why, why waste
that's 1%, by the way.
Why
One day,
waste
1%.
your time on the Chinese government shutting down Bitcoin in some way, shape, or another? Like that's why I actually, it's not that I don't like Bitcoin or technology or alternative currencies, it's that I like this idea better. And I think that's important, is that when you want to get a really big idea, you can't just like everything. I mean, this is, so congrats, man. I mean, putting you guys put your backbone into this.
Yeah.
It has not been easy.
No.
You still have plenty of people that
haven't slept in 3 years. haven't taken a paycheck in 5 years. I don't even take a paycheck.
You're
from
not
company,
great.
Right?
You're not like you're still in good shape.
Yeah.
That's
no.
good.
It's And anyone that's seen my interviews, I wear the same clothes. I live out of one suitcase. So
gold guy.
Yeah. I mean, but we see it as building infrastructure, and back to the to transition it back to where we're at in this cycle. Last year was the most extraordinary year in central banking, and I think the analogy I like to use is kind of like think about even if we went down the fear trade path, like 2011, people were buying gold because of the fear of what the balance sheet might do and all of these problems. So it was kind of like I should probably change tires before the last laps of the race. Like we're past that stage. Now, like the car's already crashed, and we want to pull the driver out, right? So it's not about expectations anymore. Gold is already more logical than currencies with negative interest rate. Like there's no model where it's more valuable to own a euro than a dollar, or a euro than gold. Just like it's no more owning euro versus a dollar when one's negative and one's got rising rates. There's no logic. So gold is just even. So being even is the best thing you have versus currencies that are getting deleted systematically.
Eviscerated.
So to me, I think although I understand your quad one, I understand you're dollar trading. You're not gold trading. You're dollar trading. But for me, I think the other key thing is the liquidity out of the gold market is not what it was in 2011. When central banks were making orders. Big orders for gold in 2011, Russia, China, India, or sorry, not India, Russia and China, and then physical flows into India. Hedge funds and Goldman and the banks, there was a lot of liquidity scrambling to guess the depth of those orders and pulling in scrap and buying all of this. But we've destocked a lot of that Western financial system, just like the bond market. So it's very analogous to the bond market, where
you mean the lack of liquidity.
The lack of liquidity. And there's no one holding big inventories anywhere. So when people start losing more and more confidence in these currencies, it's going to continue to gap up just like it did in Q1 of last year. The day of NERP, gold shot up, $150? Brexit, same thing. And that's not, that wasn't just ETF fear. That's just there's no liquidity in the system. And I think even this move this past week, if you ask a lot of the gold traders, there's not a lot of length, there's not a lot of liquidity. So it's gapping. And I think that'll continue to happen.
Well, there was a massive never mind net length. I mean, there's a massive net short position. If you look at non-commercial CFTC futures and options contracts, 3 weeks ago, it was 2 standard deviations over what it's been in the last year to the net short side. So people are quick to make negative bets on it too.
Yeah. And the one other the one other thing for this year that I don't think is fully on people's radar, Trump versus Yellen. That is a very understood trade right now. If you follow a lot of Trump's administration even on Twitter, they're already bashing the Fed. I think in probably March, your models are probably better than mine, but probably in March the PCE is going to go over 2%.
Yep, we have that.
And so and obviously headline has already been above 2 forever. It's not like there's no inflation.
No, we have, and we might be able to show a slide here. We just our Q1 macro themes deck. Theme number 2 is called Reflation's Peak. So you're going to get like a very spiky set of inflation data, the best inflation data we've seen in 5 years in the first quarter.
And so the Fed, but this is the really interesting political dynamic that's playing out. And I'm sure Davos, they'll all have their backroom conversations and figure out how to confront this. But the fact is, the policies of Trump needs a weak dollar. But the Fed wants to pass all of the damage of QE and all these things that are going to be hard to unwind onto Trump's doorstep. You're already seeing the positioning. You're already seeing his deregulation is going to cause the next financial crisis. No, the trillions of dollars of money you printed is going to cause the next financial crisis. Like you've already sprayed the fields with oil or whatever. I think that dynamic is going to get very interesting. Yeah. And again, just like last year was an incredible year for central banking, I think this year it's going to be more and more logical to own gold. And so it's something you should accumulate and not trade. Obviously I'll speak my book for a second, but set up an account, $100 a week or $100 a month or $1,000, whatever it is, just accumulate gold.
Yep.
And then if you need it, you can borrow against it. There's a lot of things we do on our platform, but I think we're in the accumulation stage that you just need to own it and not trade it, in my view.
I'm in the big accumulation of knowledge stage today, so thank you, and sincerely, because everyone who watched this just accumulated a ton of, never mind conviction in seeing gold as a store of value and as a currency, but has accumulated a ton of knowledge. So thank you, on behalf of everybody who I'm sure is nodding right now. Thank you very much.
All right. Thanks, Keith.
Cheers. I'm Keith McCullough. He's Josh Crumb. You can find both of us at Twitter with those handles. Thanks.